What is a typical asset allocation for a golden years investment portfolio? Have you ever wondered how to best allocate your investments as you enter your golden years? Understanding asset allocation is key to ensuring your financial security during retirement. Let's break down what a typical asset allocation looks like for seniors. Asset allocation is simply how you divide your investments among different types of assets. This includes stocks, bonds, and cash or cash equivalents. Stocks generally offer the potential for higher growth, but they also come with more risk and volatility. On the other hand, bonds and cash equivalents are usually safer, providing stability and income, though with lower growth potential. As people age, their investment strategies often shift toward more conservative options. A common guideline is the 100-age rule. This means you subtract your age from 100 to find the percentage of your portfolio that should be in stocks. For example, if you are 70 years old, you would aim for about 30% in stocks and 70% in bonds and cash. However, since many people are living longer, some financial advisors suggest using 110-age or even 120-age to allow for more growth in your portfolio. This can help ensure that your investments keep pace with inflation and support your lifestyle. Let's look at some practical allocation examples based on age. For those in early retirement, typically between 60 and 70 years old, a mix of 40 to 60% in stocks and 40 to 50% in bonds is common. A small portion in cash or cash equivalents can also be beneficial for balancing growth and income needs. As you enter mid to late retirement, around 70 to 80 years old, you might reduce your stock allocation to 20 to 40%. At this stage, increasing your bonds to 50 to 60% and holding around 10 to 20% in cash or equivalents can provide more income and stability. For seniors aged 80 and above, a conservative approach is often recommended. This could mean allocating around 20% in stocks, 50% in bonds, and 30% in cash or cash equivalents. This strategy minimizes risk and ensures you have liquidity for any expenses that may arise. When considering your asset allocation, think about your risk tolerance. If you are uncomfortable with market fluctuations, you may prefer a higher allocation in bonds and cash. Additionally, consider your income needs. Bonds and dividend-paying stocks can provide a steady income stream. Longevity is another factor. With longer life expectancies, maintaining some exposure to stocks can help combat inflation and sustain your purchasing power. Diversification is also important. Holding a mix of asset types and sectors can reduce risk and smooth out returns. Regularly reviewing your portfolio is essential. Changes in health, expenses, market conditions, or personal goals may require adjustments to your asset allocation. Using target date or balanced funds designed for retirees can simplify managing your investments. These funds automatically adjust the mix over time, making it easier to stay on track. Lastly, keeping a portion of your investments in cash or liquid assets can help cover short-term expenses without needing to sell investments during market downturns. In summary, a typical asset allocation for a golden years investment portfolio generally shifts from growth-oriented stocks toward safer bonds and cash as you age. This strategy balances the need for income, capital preservation, and some growth to support a potentially long retirement. Your exact allocation will depend on your individual circumstances, including risk tolerance, income requirements, and life expectancy.